Here in Chapter 10, we're going to continue learning about partnership taxation, but specifically payments from the partnership to the partners, here called distributions, or even maybe payments from one partner or a new person that will become a partner, paying those payments to an exiting partner, a retiring partner. But before we take a look at some detail, let's review the overall concepts regarding the taxation of gains or losses. So, in a chapter far, far away, or at least at the beginning of the semester, we learned about the starting point of the gain and loss calculation, where we have a sales price, and hopefully the simplest type of calculation we come across is just receiving cash. Cash makes things so easy to work with. $1 of cash is going to be $1 here we record, equal to also the basis now of whatever we're acquiring or someone is receiving. But many times, what you get is not just cash, but other property, okay, property other than cash, like an automobile, or maybe a building you're getting, or even a computer, okay? And it's hard to value that item. And also maybe you have to look at the adjusted basis of that item, whoever is giving it to you, their cost basis or adjusted basis. And maybe you owe money, but that person who's acquiring the property from you is assuming that liability, that debt. So getting rid of that liability, debt relief, is the value you're receiving that would be combined with the cash or other property to get the total sales price that you're receiving. But from that amount, you have to subtract out selling expenses. And the big one would be, if in the case of real estate, sales commissions you have to pay, or attorney's fees for legal documents, or escrow costs, maybe even accounting fees, so we can get employed and take our cut of the business here. And what's left over is called amount realized. Now, this is not the gain or loss. This is just the extra benefit or the benefit left over after paying off the selling expenses. Now, from that amount realized, we would subtract out the adjusted basis of the property being disposed of. In the case of what we're disposing of here or using up here in chapter 10 is the adjusted basis of the partner's interest in the partnership, their cost or adjusted basis. And if the amount realized is larger than that adjusted basis, we're going to have a realized gain. And of course, we typically pay taxes on gains. Or if the adjusted basis were larger than the amount realized, the difference would be a loss, a realized loss. So now, just because we have a realized gain or realized loss doesn't make it taxable gain or taxable loss. If the gain is taxable or if the loss is deductible, we have a category called recognized gain. Now you're going to pay taxes on that gain. Or recognized loss. Now you get to deduct the loss and save taxes. Okay, so that's one category. Another category is unrecognized gain. So the typical situation here is if you sell your personal residence and you qualify for that 250 or $500,000 exclusion, that gain is tax free. Or if you sell your home at a loss, your personal residence sold at a loss, that loss is non-deductible or unrecognized. Maybe a gain is taxable, but you get to defer it or postpone it. deferred gain, or even possible deferred loss. So it goes unrecognized. And the way a deferred gain or loss typically happens is that it adjusts the basis of whatever property that you're receiving in exchange for the property you're giving up. So if you're deferring gain, that's going to reduce the cost basis of whatever new property you're acquiring. So the gain now later on when you sell the new property is going to even be bigger. That will include the gain of the old property. Or if you have a loss being deferred, the basis would have increased for the new property you're acquiring. So when you dispose of that new property, or if you depreciate the new property, you're going to have a bigger loss or more depreciation. So possibly unrecognized gains and losses could be deferred because you're adjusting the basis of new property you're acquiring. But let's focus on this recognized gain here, or recognized loss. Really, really, it's the recognized gain. Okay, so we have recognized gain. So how are we going to be taxing this gain? The best type of gain, of course, is unrecognized, right? Tax free. But if you have to recognize the gain, or even possible loss, but the gain especially, you want that gain to be a capital gain. So here's capital gains and capital losses. And we learned in that chapter near the beginning of the semester, we have to group them either by short term or long term. Short term gains and losses are netted together, and long term gains and losses are netted together. And if one net is a gain and the other is a loss, we net it one more time. And the best situation is when we have left over a net long term capital gain that gets taxed at lower rates. And a low rate could be as low as 0 or 15%, or relatively high 20%. It depends upon the taxpayer's marginal rate. If you end up with a short term gain, that's going to be taxed as ordinary income. Ordinary income is taxed at the regular tax rates of the taxpayer. Another situation where gain can be taxed differently is if you're selling, if you're disposing of a Section 1231 business asset. Typically, these are depreciable assets, including land used in business. And if you have a net Section 1231 gain, that gain is taxed like a long-term capital gain. If you have a net Section 1231 loss, that loss is deductible against ordinary income. So you may get the best of both worlds when you have a Section 1231 asset being sold, except in the case of, we learned, there may be depreciation recapture. Remember that Section 1245 recapture? They'll turn the gain to the extent of accumulated depreciation into ordinary income again. And any rest of the gain may be then taxed at the long-term capital gain rates. Or to make things a little bit more complicated, we may have unrecognized Section 1250 gain on the sale of real estate that's taxed at a maximum rate of 25%. Okay, not minimum but maximum rate. Otherwise, the marginal lower rates would apply. Let's see. And of course, if your gain or loss is from selling an ordinary asset like inventory or accounts receivable, that will result in ordinary income. So you can see here maybe three different categories of income. at least generally. You have capital gains and losses, Section 1231 gains and losses, and ordinary income or loss. And again, the best situation is to have a long-term capital gain tax at lower rates if you have a gain. And if it's a loss, you want the loss to be an ordinary loss. Another thing about capital gains and losses is if you have a capital a capital loss, a net capital loss, then you can use at least 3,000 of this loss to offset ordinary income. And any extra net capital losses is carried over to next year to offset next year's capital gains. And again, up to 3,000 again of any excess capital losses can be used to offset ordinary income. So why are we reviewing all of this here in chapter 10 for partnerships? Well, generally, a partnership interest is a capital asset. And again, when you sell or dispose of a capital asset, you're going to have a capital gain or loss. But of course, that's the general rule. There's always exceptions to general rules. Possibly the gain could be treated as an ordinary gain, ordinary income, at least part of it. And same thing if you have a gain, what in the sale of a partnership interest, maybe recapturing part of that gain at Section 1245 will turn that partnership gain on the disposition of the partnership interest into ordinary income. Let's take a look at some principles here regarding when a partner is selling his or her interest in a partnership. So again, we need to calculate the amount of the gain, and we just went through that formula. In the case of the selling partner, that cost basis is not the capital account being kept track by the partnership, but as the partner's outside basis. In other words, in this calculation here, this basis is the outside basis of the partner's interest. So this could be based upon whatever the partner had initially paid to buy that interest, not from the partnership, that's inside basis, but buying it from another partner or another individual. And the partnership doesn't keep track directly of that amount. Also, in the adjusted basis, you would have to add in the partner's share of his or her amount of liabilities they're going to be liable for, at risk for, of the partnership. So I believe in this chapter 10, some of the homework problems will tell you that the partner's basis here, the outside basis, may include the liabilities of the partnership. So when you try to figure out the gain or loss, it's already built in here, their share of the partnership interest, but not built into the direct sales price. So like right here, you have to add in the relief of the partner share of the debt as part of the sales price, but it's already included in here. In a real life calculation, many times you would put it in here and you would put it also in here so it'll cancel out each other. But that's not the case of some of the numbers given to us for homework, maybe the Learn Smart problems for chapter 10. So again, we're figuring out the gain or loss, but then hopefully it's capital gain, or hopefully it's even ordinary loss. But maybe the gain has to be treated as ordinary, or at least part of the gain. So we're learning a topic here in chapter 10 called hot assets. If you were to sell certain assets of your business, you would have to report ordinary income. One of the assets that may not be yet recorded in the accounts of the business is not accounts receivable, but unrealized receivables. Unrealized means that it hasn't been reported yet, especially for cash basis taxpayers that haven't collected the money yet. Accrue basis taxpayers already booked, already recorded the account receivable, already credited the revenue. So that income is already recorded as taxable by the partnership. Unrealized receivables, the revenue hasn't yet been recorded because they haven't collected the money under cash basis. But it still has value that's still attributable to the partners in the partnership, something they own. Okay, but now they're receiving interest from the partnership, maybe cash, and it could be related to this ordinary income item that hasn't yet been reported. Okay, and most of us learned accrue method of accounting in our past accounting classes. What's not emphasized but very, very common in the real world is cash method taxpayers waiting, especially a service type industries, professional type businesses like doctors, lawyers, even accountants, even plumbers. They don't report any income until they collect it. But that income that's owed to them, the receivables owed to them, still has value. Here we call it unrealized receivables. And someone has to report this as income, ordinary income. And to be fair, if a partner is receiving a distribution, even a liquidating distribution, maybe that part of that distribution should be treated as ordinary income. Inventory may also be treated as ordinary income if it's substantially appreciated in value. When you sell inventory, of course, hopefully at a profit, the gross profit is taxed at ordinary rates. So if the partnership has inventory, substantially appreciated inventory, maybe any distribution, maybe any proceeds a partner receives upon liquidation of the interest has to be treated as ordinary income. Also, again, I mentioned a couple of slides ago, Section 1231 sales profits is generally treated as long-term capital gain unless there's Section 1245 recapture that's taxed at ordinary income. So the simple formula in calculating how to tax a partnership or partner is to look at the gain or loss, and we went through that whole calculation already. But from that amount, we have to allocate how much goes to the partner and treat it as ordinary income. And then the rest is treated as a capital gain or loss, taxed at lower rates or deductible with some limitations. So if you're buying a partnership interest from an existing partner, then whatever you pay for that interest is not going to be known by the partnership directly, but that's going to be your initial cost basis. And to that, you're going to add any share of your partnership liabilities to get the total outside basis of that partnership interest. So we cannot just look at the capital account, the owner's equity for that partner in the partnership's books. Each partner should be responsible to keep track of their own partnership basis, their adjusted basis. And we'll go through an example of how things can change for a partnership's basis. In fact, it discusses it here. It can increase, a partnership's basis can increase if they contribute now more property to the partnership. Also, if the partner is allocated their share of the profits during the year, that will also increase their share of increase the partner's basis. And just the opposite, if the partner takes a distribution, and that's one of the topics here in this chapter, that's going to reduce the partner's basis. Or if the partnership has a loss, the partner's share of that loss is going to reduce the partner's interest. In calculating the partnership income or loss during the year, um, all we do is just divide it up at the end of the year. But if partners change during the year, we may need to allocate the income among the old partner, current, continuing partners, and new partners. So let's go through an example that discusses the two possibilities here. So let's say this is the year from January 1st through December 31st. And to keep things simple, we have two partners. We start off with partner A owning, let's say, 50% interest, and partner B has a 50% interest. But then during the year, let's say exactly halfway into the year, this is June 30th. Partner A sells his or her interest now to partner C that takes over the 50% interest of partner A. And partner B still remains a partner throughout the whole year. In a real life situation, partner A needs partner B's permission before they sell their interest, yeah, to anyone. A partner is just like a spouse. You have to be able to get along, so everyone has to agree. So let's say we have $100 worth of income or loss at the end of the year. How would you divide this up among the partners? Well, if you use this prorated method, partner B will get 50, half of the income, and partner A will get 25 because that's half of the half for the year, and partner C would get the other 25% for the remaining part of the 50% for the year, okay, totaling up to that 100 we have to allocate. That's the prorated method. Or you could actually have what they call interim closing. You close your books right here. You figure out how much revenue and how much deductions you have for that first half of the year. And whatever that total is, you divide it 50-50 among partner A and B. And then for the rest of the year, again, you would close your books for revenue and expenses for the last half of the year and figure out the net income or loss and divide up that between partner C and B. And of course, it's hard to predict how things will work out by year end at the time of the sale of that partnership interest. Now, if there was lots of profits here and I'm partner A, I would want this prorated method because the less profits here would now be kind of merged into the second half of the year, pushing that profits to be taxable to the new incoming partner, yeah? But if this was real profitable here, I want this cut off as partner A to get a smaller income allocated to me for the first half of the year. But all of this has to be probably determined right here when the sale happens, and it's hard now to read the future, what's going to happen for the last half of the year. Let's see how, again, summarizing how all of this increases or decreases a partner's interest. So let's say here is the partnership, and we have at least one partner down here. So we saw back in the chapter 9, to form a partnership, a partner would make a contribution. Could be cash. Again, it keeps it simple if you contributing cash. Or could be other property where the amount now is a cost basis being carried over from the partner to the partnership. Now this partner has an asset called a partnership interest in this partnership, and that asset has a cost basis equal to the cost basis of what's contributed. Cash is the same as its face value. A dollar cash has a cost basis of $1. The cost basis of equipment, the cost basis of a building, the value and the cost basis are two different things. Many times, most times, people look at the value. Tax accountants look also at the cost basis because the cost basis of the property given up is equal to the partnership cost basis here, partnership interest. Now, if the partner withdraws money from the partnership, let's call it withdrawal, that's going to reduce the cost basis of that partnership interest. So that makes sense, right? A mirror image. Contributing, increase cost basis. Withdraw, reduce cost basis. Now again, if it's cash being withdrawn, a dollar cash is going to reduce the cost basis by $1. But if you're drawing other property, whatever cost basis you see here in the partnership, that's what you're going to reduce as the cost basis to the partner's interest. Other things that may change the cost basis of this partner. Let's say this partner acquired his or her interest from another partner. Here's an old partner, and our partner pays this partner here to buy the partnership interest. Okay, whatever this payment is the initial cost basis of the partner, of this partner. They didn't make any initial contribution to the partnership, but it's this outside payment to an old partner is the initial cost basis to the new partner. This payment here is not reflected on the books of the partnership. So that's why we call it outside basis. Another thing that may affect the basis is any liabilities of the partnership. If if the partnership cannot pay off its liabilities, general partners are considered to be liable for those liabilities. They're so-called at risk. So liabilities of the partnership also increase the cost basis of the partnership interests of the partner. If liabilities go up, if the partnership borrows money, the partner's interest basis goes up. If the partnership pays off liabilities, the partner is less at risk now. It reduces the basis of the partnership interest. And liabilities go up and down every day in a business. Just having accounts payable, definitely taking out a mortgage, yeah, will change, and paying off the mortgages will make the liabilities go up and down, increasing the outside cost basis of the partner's interest going up and down. Couple more examples of changing the adjusted cost basis. So again, the partnership has revenue, has expenses, has profits and losses, and the partnership doesn't pay taxes on this income. It's the partners that pay taxes. So this profit and loss has to be reported by the partners, his or her share, like we learned in the last chapter. When the partners are allocated income, net profits, that'll increase the partner's basis. If the partner is allocated losses, that'll decrease the partner basis. Now keep in mind, allocating profit and loss doesn't mean you're paying the partner any money. All you're doing is increasing or decreasing the partner's interest because they're reporting the income or loss on their individual partner's return. Okay, so don't confuse profit and loss with withdrawals. Withdrawals is just money flowing from, or other property flowing from the partnership to the partner, reducing the partner's basis. Profit or income is going to increase the partner's basis because the partner has to report that as taxable. Losses reduce the partner's basis because the partner gets to deduct that loss most times. That's again the general rule. Let's take a look at distributions from the partnership where the partner continues to be a partner in a partnership. And in part two, the next video, we'll take a look at distributions where we're going to liquidate the partner. The partner doesn't continue to be a partner. So the easiest situation again is when we're just dealing with money. Here, the distribution of cash from the partnership to the partner usually does not um, have any gain or loss being reported to the partner. All we're doing is reducing the basis of the partner's interest in the partnership. Only when the money received by the partner is bigger than this basis, any excess is going to be reported as a gain. There should be no loss on an operating distribution to a partner. The partner is still continuing to be a partner. But once the money received by the partner, I guess it's by year end, for the year is bigger than the, the partner's basis in that partnership interest, any excess is taxable as a capital gain. And what you're doing is reducing the partner's basis down to zero. The outside basis cannot go below zero. And that's kind of summarized here. We don't recognize any losses on operating distributions. There could be a loss if it's a liquidating distribution to the partner, but here it's not liquidating. So to make things a little bit more complex, we're now going to distribute maybe money, but also property other than money. So you need to first see how much money that's being distributed and reduce the partner's basis by that amount. Then you look at the other property being distributed, the cost basis in the partnership, and reduce the partner's basis by the partnership's basis. And again, you cannot reduce it below zero. Let's see, carryover basis. Yeah, you whatever basis in the hands of the partnership now carries over to the partner, and you allocate basis to that property, reducing the partnership interest basis. This is the order that you take that mentioned in the previous slide. You first allocate basis to the money being received, and any rest of the basis is allocated to the other property. And you cannot reduce the partner's basis in his or her partnership interest again below zero. Let's stop here, and when you come back to take a look at part two, we'll talk about distributions again, but this time to liquidate the partner's interest in the partnership.